Hi. Thanks for, you guys changed the screen, by the way. Thanks for joining us at the Singapore Fintech Festival. I am Joel. You're joining you here from the Rapyd office in Tanjong Pagar. On the virtual neighborhood, this is at the Boat Key, the networking work stream. I am thrilled and privileged to be here with Varun Mittal, one of the most illustrious fintech pioneers in Southeast Asia, although not necessarily known to everybody, extremely well known and beloved in the fintech community. So it's been a pleasure to have you here, and thank you for joining us.
Thank you, Joel. Thank you. Thank you for the kind words.
Oh, my pleasure. They'll get kinder as we go along, and maybe a little bit less kind. So first, maybe just introduce yourself very simply.
My day job, I run the fintech practice for EY for all emerging markets globally. My evening job is I wrote the Singapore Fintech Nation book. So I bring the story of how Singapore has become a fintech hub to all over the world. And my night job is to hang out with fintech founders to see any areas where we can help them to grow and scale up and solve problems.
There's a lot of jobs already.
Absolutely.
But 45 minutes is a lot of time, so let's take it slow. So to start with, how did you get involved with payments?
I graduated from MBA, and Singtel was looking for somebody who did telcos before and was willing to learn payments. There were very few people who know a bit of marketing sales, knows telco, and try to learn payments. That's how I ended up there. And at that time, it was direct carrier billing or direct operator billing, premium SMS time, selling applications through app stores, selling games, the Zynga, the Facebook credits, all of that. PayPal used to have a subsidiary at that time also doing that business. Started from that perspective. Had 250,000 customers within 6 months in Singapore who were buying apps and content through operator billing. And that time, Samsung was also trying to scale their app store. They said, come on our side and do this for us. Instead of doing for one telco, you come for one app store and do it for us for all telcos. And because they didn't have budget to have one more resource to do credit card and wallet payments, so said, now you learn credit card and wallet payments also. We don't have budget for 2 people. So, okay. So ended up learning all the other side, thanks to less budgets. Was doing that, and then HelloPay happened. A bunch of people were trying to build first pan Southeast Asia gateway. Gateway plus wallet, Lazada was backing it. So it was the same eBay, PayPal story. The largest e-commerce in the region is backing. You can bring the whole story. You start the counter with $1 billion GMV. And 5 years ago, $1 billion GMV in Southeast Asia was...
Sounded like a lot at the time.
Yeah, so I'm like, okay, so what do you want? He says, wants one person, somebody to come, be the first marketing and sales person. We don't even have a Facebook and Twitter page. Come, set it up, build it up the way you think you would build it. Right. We were doing that. 9 months into the journey, and Financial came in, said, we want to buy. Went through the journey, went to Hangzhou, whole process. During that time, transition from marketing and sales to build the whole product because the merchant side of the product was not ready. And when the product was ready, the rest of compliance and operations was not ready. So transition from marketing sales to running the merchant product to running the whole operations, including treasury. So learned like a steep learning curve. And then handed over the company to Ant Financial. We were the first company to be acquired 100% by Ant Financial. And was rebranded, HelloPay was rebranded as Alipay Southeast Asia. During that time, I was also EY Accelerating Entrepreneur of Year, along with Prajit, who will be here tomorrow. So all of us are from the same batch of Accelerating Entrepreneur of Year. And then we handed over the keys to the mainland.
There you go. That's a lot to unpack there already. So going back to direct carrier billing, the golden age of online payments, apparently. What was your favorite piece of premium content that direct carrier billing was a great service for?
A lot of media content, micro payments, the 50 cent, 100 cents, or $1 content where you're getting magazines and stuff. For that, it was very easy because you were not something buying every time. You're buying it once in a while. And then you do not want to enter like a 16-digit. Right. So for those small content micro transactions, which are non-recurring, it was pretty interesting use case.
And do you see DCB as still being relevant today?
It's struggling to be relevant, I would say, because the costs are slightly higher. The any operator's cost to run DCB is pretty high. And they would struggle to have the same fraud and risk management systems. Because right now what's happening is you would hear in the news so many telco fraud cases where people are talking about OTP being asked and stuff. And putting the same level of fraud and risk management system, which let's say the card companies have, is complex. And that's, so premises you're dealing with that, while the card payments, the direct rails, the pay nows of the world, have got into that micropayments as well. So it's a complex field to be in at this moment. And specifically with the amount of fraud which has increased, the chargebacks and stuff, I'm facing one myself. Somebody hacked my phone from somewhere, and
I'm very sorry to hear that.
And I'm going through how the process will look like for chargeback.
What was the payment method?
Operator billing.
Was it? Interesting.
Operator billing, because the chargeback process doesn't work. Because there is no chargeback process and guidelines for that. So then you're pinging between the content provider and the telco, and that world is still not mapped out fully.
Interesting. Okay. So if retrofitting fraud protection for a scalable digital fraud world is the problem for DCB, what do you see as the level of maturity for all the new payment methods that we see coming out here now? So take cards out of the equation. How confident are you in the risk platforms that you see in newer forms of payment?
I am not too confident about most of them because they work perfectly when everything is right. But when something is not right, that's when the stuff starts to break. For example, we had a scenario where in Malaysia, there was one fintech using direct account pull, and there was some API failure, which caused it to work recurringly and emptied the bank accounts of people.
Yeah.
So because the premises, the amount of fraud cases, risk management scenarios, AI, ML models which have been built over the rails, it takes time to migrate them. And just because something is cheap doesn't mean it's always good. So there is a lot of work which needs to be done. I feel that the direct pull payments are not at the level of maturity from a fraud and risk management perspective.
Well, I mean, pull, that's maybe a higher bar, but even, are you seeing the right level of maturity in push payments?
Push payments are, I would say, slightly ahead, but they still need to do a lot more on buyer protection and seller protection, specifically much more on buyer protection. Buyer protection is still not to the level where customers can be confident of, can be as confident as they are on the mature payment methods.
Right. Okay. Fair enough. We'll come back to that, I'm sure. So, since you are one of the great cheerleaders for fintech in Asia, and as you mentioned, your role is global, is the fintech boom overhyped?
I would say there are parts of fintech boom which are overhyped, and there are parts which are actually making difference. So specifically the parts which are bringing access, which are breaking the old barriers of access. Because in the traditional world, people would be segmented artificially. That this is your net worth, so this is why you get access to these things. The current generation's view is, if my Netflix is same as yours, my Uber, my Spotify, my iPhone, my App Store are same as yours, why should my bank account, why should my wealth management, why should my insurance offering be different than yours? So which is why wherever fintech is looking at democratizing the access without putting labels on people based on their net worth, those places they're actually creating impact, actually creating difference. But there are other places where the goal is that, okay, we will monetize, we'll figure out how to monetize later, let's just throw everything. So the value, some people who engage in, like I would say, value destructive competition, where the only competence is price. And it's not that they're price efficient, it's that they want to monetize through different channels at some later date. So those are probably a bit of overhyped. Which is why like people say, oh, digital banks have done following things in this market. But if you look at the top 10 banks, deposit base in the pandemic year has increased in the United States.
Sure.
So there is, on one side, there is a flight to quality. Yes, there are digital banks which are growing as well. The question is, who is going to lose? It's probably the weaker financial institutions or smaller financial institutions who neither would have capital nor have the investment to do that much tech will suffer. But it's not that the top end of the banks will suffer. It's the weak middle or weak bottom will suffer.
So going back to briefly, so you said institutions or platforms that increasingly democratize the experience are the ones that you think are kind of more the future.
Yes.
What's an example of that?
So think of it, companies, so like stock trading, for example. They reduced the costs and everything, and they allowed everybody to be able to trade. Now you have platforms selling institutional class funds, which were earlier not available to the retail class investors.
Right.
Or discretionary asset portfolios. Normally you would need at least $2 million to go to a private bank to get access to it. Now you can get it even at 50K.
Sure.
Bonds trading. Singapore has its first bond exchange live. Even at $1,000, you can start to buy bonds. Earlier was anything less than 250K, you can't even step inside the room.
Well, let's take the contrarian view of that, right? Is bond trading or options trading something that an average person should really be doing?
The premise is this, right? Average person who doesn't understand, no, but they should have access. And if they, so for example, bond trading, probably not, but buying bonds, because the interest rates are so low, your savings bank account in Singapore is going to get you less than 0.5%, unless you can really optimize through those high yield accounts. It's probably not bad if you are holding bonds to yield to maturity for some of the stable players, which are going to give you 3-4%, and you have a financial advisor who is helping you with that process. And because see, just because access is there doesn't mean it's always DIY. You can have assisted access as well.
Right.
And the premise is access is there, and if it's not right, doesn't mean you have to still use it. But now you have access.
But do you think the industry is able to self-regulate in terms of helping make sure users have the right tools, the right metering in order to not shoot their own foot off?
The existing regulations needs to stay around client suitability and client analysis. I would not bet on self-regulation in something like this, right. Because the incentives for a lot of people can be very different. So I would not bet on self-regulation, at least for this part.
And would you say we've seen some negative examples of that already?
Oh, absolutely. You see court cases all the time where people are suing that so-and-so person sold me this policy in this name or this products in this name. So you have that challenge all the time. So right. There are enough negative news around that.
And so, but are you interested in regulators stepping in and doing more? Or do you think the existing regulation needs to be enforced around client suitability?
See,
and that's an insurance concept, I think, right? What about the brokerage world? What about other services where the lines are blurrier?
See, in the brokerage world, if the customer their disclaimers are already there. Brokers put that, so brokers are required to not offer specific products to non-accredited investors. So that's till where the regulation can act. Regulations, to be honest, cannot go and control somebody giving advice on a social media platform. That's something which a regulator can't control. Because I can have my own YouTube channel and speak anything. That's not a financial advice. Because if a regulator starts to go there, that becomes complex. Because then they have to look at every news channel. Every news channel has some commentators who are telling this is good, this is bad, this is expensive, not expensive. That's a totally different territory. So I do not expect regulators to go there, but to ensure the brokers can be required to explain that and probably add 1 or 2 more steps that if they're pressing something, some complex trades, to give the warnings. But anything beyond that will probably, it's a thin line.
Right. All right, so you're not promoting additional regulation to protect consumers yet?
The premise is, see, you cannot, even if you put some regulations, how would you enforce it? I am not a fan of a European model of passing a regulation without having a clue of how to implement it.
Okay, fair. fair.
Announce that everybody should have APIs, but no standards, and there are 25 different standards, and a small fintech dies trying to adapt to 25 different standards and maintain those APIs. And you end up only the super large companies being able to afford surviving with those 25 standards.
Fair enough, fair enough. Everyone note the Singapore FinTech Festival t-shirt, by the way. so going backwards and going lighter. If you couldn't use the term FinTech, what term would you use?
FinLife or TechFin?
What would you use perhaps with your grandmother?
I would just say more of, so I usually have this challenge with my father, who actually asked me, so what exactly do you do?
Yeah.
So my answer is very simple, that I help, so now you do everything on your phone. I help bring all the financial services to your phone so that you don't have to go to the branch and call your broker.
There you go. Sounds good. In terms of financial services on your phone, what are your 3 favorite apps?
That's complex. I have to endorse somebody now.
There you go. What is some of your personal use?
Personally, I use Endowus and Crystal for wealth, Utrip for cross-border payments.
Okay, sounds good. Thank you for your honesty. So beyond COVID, which was obviously a surprise for everybody, in our industry, what would you say was the biggest surprise that you had in 2020?
The biggest surprise, I would say, was the openness from the banks in Asia to open the bank as service platforms. Mm-hmm. So in Singapore, you had some of the largest banks open their platforms in white label format to fintechs where the consumers and SMEs could open their accounts. Mm-hmm. I personally didn't expect Singapore banks to be that open and move that fast from that perspective. And at least 2 of them are already production live where they're giving APIs to a lot more fintechs to do like an on-demand virtual bank account as a service. So
what's the business model?
The business model is very simple for a bank. There is a long tail which we cannot serve efficiently. We're happy for you to serve. The CASA still sits with us. When the loan and all of those products comes, we will be there. You can serve the long tail.
Okay, so that's the white labeled account model or the co-branded account model, not the data sharing model.
No.
Okay.
So data sharing is too complex, and a lot of times people put too much value on that data. Mm-hmm. Unfortunately, you can't do as much as people think from that data. Because, for example, a remittance company is giving you a virtual bank account. The number of remittance transactions you do have very limited correlation to the full business, what you're running. Yeah. And if you're going to underwrite somebody's credit just based on that, I'm not sure how sophisticated would that analysis be. Mm-hmm.
No, fair. Do you feel like that lending side, there's been some famous blow-ups, right? So Chinese regulation has pulled back, Indonesia regulation has pulled back. Are there examples where you feel like the ecosystem around lending has evolved in a positive way?
I would think so, because what has happened is what even the fintech lenders have figured out, that they need to look at some of the co-lending models with the financial institutions. Because these financial institutions have seen many cycles of risks. They've seen ups and downs, they've seen stuff blow up. And for the banks also, this is a way to acquire new customers, to go after segments which on their own they would not be able to go after. Mm-hmm. So those kind of collaborative models where the co-lending models have come mainstream, that's something which I see evolve, where both sides have accepted these are my strengths, these are my weaknesses, and then work together and we collaborate on this.
Sounds good. So just for the audience that has joined us, thank you for so many people joining. I did have some messages and WhatsApps before this session with people threatening to ask Varun extremely timely questions that otherwise he's too slippery to answer. So now's a perfect chance to do that. Just go in the chat. I do have it on my phone here. If you have an AMA question and ask me anything question for Varun Mittal, now's a good time to do it. Salim, I'm looking at you. Cough up a good question as we speak. So what are the constraints on the growth of fintech at this point?
I usually say this. The valuation will not let them have a cash exit, and their burn rate will not let them live.
There you go. It's pretty good, actually.
So a lot of them have achieved a
Too valuable to fail.
No, it's too valuable for somebody to buy them out on cash.
For sure.
The public markets are not that mature, at least in this part of the world yet. Yeah. Nobody will take a cash. So just very simple example. The largest cash acquisition in Singapore has been 45 million.
Really?
That's the largest. Have you seen a single one larger than 40 in Singapore?
Only in my dreams.
The largest one across Southeast Asia acquisition has been sub 200 million in Indonesia.
For all cash?
Huh?
For an all cash.
All cash. So which is why if you have crossed the 100 million bucket, there are very few people who would buy cash. Mm-hmm. Yes, if you're going for a stock swap and stuff, that's a different deal. Right. I've seen enough of the Silicon Valley and this .com. On a pure stock to stock, both sides can value themselves to anything. Right. The premise is the path for companies to create exit opportunities for that.
But is that a constraint? I mean, that's a great fun fact, but is that a constraint on growth?
Yes, because I'll give you an example. So for example, in Israel, so they have a lot of companies which are public, but they have figured out the 100 to 300 million is a sweet spot. And the founders there have gone through generations. So they know that this is a window in which you exit, recycle the cash back, the founding team and the other people go and start new companies. And yes, some of them will break out and they will go all the way to IPO.
Right.
But usually 100 to 300 is the sweet spot, and then the people would have like multiple exits in that basket, and they turn around fast on this.
So in which case is the SPAC, the special purpose acquisition company, is that the exit that you're looking at?
The question is, where will you take the SPAC to? If you're going to take a 300 million SPAC to US, nobody would care for it. And if you're going to take a 300 million, you don't need a 300 million SPAC for Singapore. You can, at 300 million value, you can already list. You can already list on Catalyst on 300 million valuation. The question is, would you have enough people who would get the business model, and would you have enough traction? And if there are businesses, so for example, a credit scoring company, credit bureau company got listed last week or the week before, pretty much premium and everything, the EBITDAs were pretty high, 50% EBITDA. That's something works. So you can have a path here. The premise is this, right? If you're not profitable yet, then how many investors and what's the investor excitement you will have here to list in Asia? And Asia, as I'm talking Southeast Asia. If you're going North Asia, Hong Kong, that's a different ball game. But again, it's tough for you to go with 200, 300, 400 million valuation there. You need to be slightly bigger to go there because those are, I would say, bigger arenas.
Right.
So which is why, what's the path and where do you find those opportunities? So that for me is, because people raise and stuff and they're like, okay, at this much AUM, at this much GMV, I will have 10, 20 million revenue and I'll be sustainable. Just fair. And there are two schools of thought. There's people who are chasing the unicorn and going a SPAC or something at that point. That's a fair path. Or the people who are saying, I'm somewhere between 50 to 100 million. It's a fine thing. I'll exit, I'll recycle, and I'll rebuild. So that for me, solving that exit path, and both for the founders as well as for the early employees, even if it's through secondaries, a private equity can come, take over, run the company, and there is secondaries for the early employees and staff, that works. But having that chain reaction, that's important.
So PE and a secondary, that's one exit path. Well, what other advice are you giving people then who are in this, sort of, I'll call it a bulge in the middle, right? Where the business is not big enough to be global and have an exit at that scale or not? What would you tell them?
Find other global markets to have enough global footprint, because then you can have some level of growth capital to take to the next level. Because you've reached the point where you cannot go back. Your only path is forward. Now you need to move forward as fast as possible.
Okay. And are you seeing Asian and Southeast Asian fintechs expanding globally fast enough then, or being successful? They're
trying. Of course, COVID impacts. They're trying. Time will tell how things work out. But that's the only path. Because the premise is, the longer you run, because this was one thing I was telling to a founder. He asked me, like, so what should be my path and stuff? I said, ask your one downs, not you and your co-founders. Ask your one downs, how many years can they fight long? Do they have 5 years left in them, 7 years, or 9 years left in them? So key question I usually ask is, what's your one downs team stamina and commitment left? And that defines how big an outcome are you going to go for.
All right. We'll come back to that. So one of the things that you spend a lot of your time on is building community in Southeast Asia, right? What's your observation of how the community works today, and then what steps have you taken to play a role in that community?
So one of the communities I run, Fintech Chopal, started 5 years ago, 5.5 years ago.
What is the Fintech Chopal?
So the word Chopal means like a village center house. So in the traditional Indian villages, you will have an area where people will sit there, talk, ask their problems, get the solution solved. That was what the word Chopal means. And 5.5 years ago, I just set it up for a couple of people who were in payments and we were trying to solve problems and we couldn't ask anybody. So we'll just ask each other. And then organically, it kept on growing in stuff. Now it's 250 people, 256. capped thanks to WhatsApp's limitations. And it's a safe place for people to ask questions, share their feedback, ask problems. Regulators are inside to share their opinions, discuss with there. And what I've seen, the key difference is, 5 years ago, it used to be that everybody would protect the access. People would guard the access. What has happened in last 2-3 years, people have figured out that there are multiple lateral connections for everybody to move. It's better for you to help each other because one, you may need it back, and second is you may not end up actually being the gatekeeper. So people used to tell me that you're a weird guy, you're opening your Rolodex to everybody in the group and you're an idiot.
Yeah.
And I like, if the other person is committed enough, that person will figure out a way to find that other person. And if it's not committed enough, then even he having the same person in the group, he or she would not do anything with it.
Yeah.
So that acceptance has come much more, where people have accepted that the guarding the Rolodex is old generation model.
Yeah. I was listening to a podcast this weekend about the death of Tony Hsieh from Zappos. And one of the stories was that somebody had called one of his client service people to try to hire them away. And Tony got the phone number of the hiring manager and said, no, don't hire the guy. You come here. I'll train you in everything you need to know, and you can take it back to your company. It's like, so that idea of openness, making all of us better, is impressive. And I think as a beneficiary myself of what you've built, I think you've definitely gone above and beyond, right, creating a community for fintech in Southeast Asia. So there's two topics of the hour, right? Your confluence of forces coming together, and we'll see which one you want to address first or second. But one is the digital banking marathon. So just announcements on Friday in terms of who's won the digital banking licenses in Singapore. And then you are advising at least one of the teams, if not several of them. Tell us a little bit about Greenland and what it's about, who the co-founders are, who the investors are, and what you guys aspire to do.
See, the background we have to look at from the wholesale banking perspective. Till last week, Singapore had 99 wholesale banks. And all of them were actually foreign banks with their branches here. And they were mostly targeting wholesale banks, wholesale clients, corporate clients who were doing cross-border businesses. And that has been the premise. Now, from 99, there are 101. If they were all three awarded, it would have been 102. So it dramatically doesn't increase or decrease the competition. Technically, there's 2 or 3% more players in the domain. Yeah. It doesn't revolutionary change. The premise is, and again, regulators have defined the criteria and everything. And there were different models to look at the wholesale banking. One model was to look at what can you do to serve the local SMEs for their local needs. The other way to look at is what can you do for the overseas specific corridor needs and everything. And what regulators have looked at it, they've looked at specific needs, and their definition of unmet unserved needs are probably something which they have looked at from their perspective. And based on that, they have looked at people who can help specific corridors for wholesale activities. That's how they have looked at it, and there's still a third license left. And I'm sure Ramesh would be thinking through the process and everything. But the idea is the specific needs around ESG, sustainable finance, how corporates who are looking at large projects across multi-markets, how those can be served and addressed. So those are specific areas where there would be probably more action.
So what is Greenland doing?
I will have to wait for this week's announcements from them for them.
Fair enough.
Something they will share news. It should come soon.
Okay.
I will not steal their thunder.
Let's go up a level then. How is digital banking different from a bank that's modern?
I will come back to the point which we talked earlier about segmentation. The traditional, a bank which is digital is still having the segments the old way. You still have a retail, a premier, a private, and a private plus. And usually the same person may actually be fitting because the bank doesn't see all the assets the person has. So that segmentation is there from the previous times when you had branches. And okay, this is a rich person, they'll have access to a special branch, special RM. This is a not so rich person, he has to queue up. This segmentation is a 25-year-old segmentation. and the current generation where all these people would want their stuff right here, right now, on the similar device. The segmentation doesn't hold. So there is an opportunity for the digital banks. And if you see digital banks all over Europe, you would not see them having these many segments. They may have like tiers that, okay, this is a metal, non-metal, but it's everybody can upgrade, downgrade, and there is a fixed fees. It's not like an entry ticket. That, okay, you must have 300,000 AUM with me for you to have the metal version or plus or premier. It's that this is the fees, $9, $20, $50. You can pick whichever one. The control is in the hand of customers if you look at all digital banks. I haven't seen a single digital bank globally where there is an AUM-based tiering where you can't upgrade or downgrade on your own. And that's something which is unique. The new banks which are starting from scratch, which are starting from a digital-first solution, they have a real opportunity to get past that old segmentation world, where they explain to the customers that, for us, this is how the access works. We're opening it. And yes, these products are regulated. That's why we can't give it to you. But if you give me enough documents for you to be accredited, I can still give you. I will not care whether your AUM is 1 million or 8 million. So that, for me, is the biggest difference. And that applies in the banks which are digital. They still have to deal with their RMs who have commission structures. They still have people buying mutual funds, so it's you're riding a tiger, you don't know how to get off it. You're still making a lot of money selling mutual funds with the trailer fees. You can't switch them to ETF because you will lose, and you can keep selling as long as you can, knowing how to get off that. So for the banks which are digital, still selling mutual funds with 2.5% fees, that's a problem. So how do they get off it?
Okay.
So because you're still making money. And usually, I was talking to a very senior banker, and he drew out a sine wave curve for me. He says, let's assume the fintech is at the peak. Half of the area under the graph still writes on the left, still falls on the right.
Yeah.
So even if it's the peak of the disruption, there's still half of the revenue still left to be maintained. So I don't need to give it up yet.
Right.
So that challenges.
Oh, for sure. But isn't profitability, or you said AUM, but that might be a little bit too fancy, right? But isn't basic segmentation primarily profitability driven? And isn't the reason for those segments that ultimately some customers make more money and some make less money, and your infrastructure is then tiered around subsidizing people who make you money?
So that worked when the cost to serve was different for each segment. You're right. That segmentation worked when you needed to have a more qualified RM and a special branch where the coffee and biscuits were served versus the person who was queuing up in the branch versus the person with limited ATM withdrawals. That worked when the cost to serve was dramatically different. Now the cost to serve is not dramatically different between the different audience segments. Because the digital banks, for example, they don't have a branch. So they have to serve everybody through the same channel anyways. Yes, they can have an RM for like somebody which is very highly valued, which is fine. You're making more money from a customer, you're giving him more access. And let's say you unlock an RM facility only above X AUM, that's okay. But the product shelf cost of servicing remains the same for the digital first with no branches.
And if you take venture capital out of the equation, how many of these digital banks actually are going to have a unit cost profitable model that they don't have to reintroduce the exact same segmentation?
See, reintroducing those segments won't help them because they can't have branches. They can only serve digitally.
But why can they not have branches? Doesn't that seem like doesn't that seem like an artificial constraint?
No, premises, then they can go and apply for a traditional bank license. Nobody's stopping them. So in China, you had a lot of them go and apply for a traditional banking license. Who's stopping them? They can apply. They can apply. The banks are allowed, right? In India, you have people applying or trying to buy traditional banks. Sure. They can. Who's stopping them? They can do it. If they want to do the traditional model, sure, they can do it. Nobody's stopping them.
Oh, I'm not suggesting the traditional model because branches are great or trailer fees on mutual funds are great, so much as banks make money lending money at the end of the day, right? That's the primary place that they make money, right? So I guess my question is, aren't there the digital banking competitions, and maybe leave Singapore out of it, but we have them all over Asia, aren't they a little bit artificial if the goal is to stir up competition in markets that are otherwise somewhat sleepy? Is this really the best, you said 1 to 3% change in the total footprint of competition, is that really competitive enough to actually make any change?
The premises is better than, too much competition in a regulated sector also can shake up the economy. So a little bit of competition is good. And that starts to create impact because then things start to move. But if you see full banking in Singapore, full banking, 2 full banks are there. There will be a lot more, and the full banks are also supposed to serve SMEs. There will be a lot more impact. Wholesale was only 2% or 3% more, but if you see full banks, Singapore doesn't have too many of them. That 2 additional is a lot more impact, and that will impact, and which is why if you see last few years, several banks have already launched the ETF-based products for wealth, for example. They have started to add more and more digital capabilities from that perspective, so that impacts. If you see Hong Kong, for example, a lot of traditional banks removed the minimum balance fees, which was because of the impact. So there is impact. Different markets will have different levels of impact. And yes, they will have to achieve profitability. The question will be 2 parts. One, is your cost of servicing much lower because of the less infra, less legacy? Can you play on that? Plus, can you look at additional segments? Can you look at segments which were not financially viable to be served earlier, like gig economy, foreign workers, SMEs below 10 million GMV? Can you serve those segments? Like how many SMEs today have a treasury solution from a bank? If you are less than 20 million GMV, how many of them will get like a notional pooling, multi-currency omnibus? Very few.
And how many will understand it, right? How many mid-market businesses truly exploit it either?
Absolutely. So like specifically the ones who are starting to do import-export, they understand. They don't know because nobody has even introduced the concepts to them. And I see there's a value if people start to do. People didn't understand travel cards until they came. Once travel cards became mainstream, people started to understand them.
Sounds good. What do you see as the regulators not doing enough of at this point? If you're here to advocate, and you're not, but let's say you were here to advocate for additional regulation, where's an area you'd like to see regulators push more of, or where you see some regulators being far ahead, you'd like to see more push in that same direction?
I would look for much more emphasis on financial literacy, because a lot of customers still fully do not understand their own needs, and it's what they learn from those blogs is their primary source. So having institutionalized financial literacy abilities for people to understand their needs and understand what they do. And Fintechs, for example, is an example on that direction. But to bring that financial literacy for people to understand the implications of their needs and how to plan for it. And COVID actually showed, because a lot of people realized how less savings they had, how less protection needs they have across the world, not just Singapore. Yeah. Having that kind of counseling capabilities. And for example, in some other industries, for example, regulations force companies to put, let's say, 1% of the profits to causes like this. So something on those lines, where which could be academic bodies or social bodies to spend industry profits on something like that. That's something which I believe would be most beneficial for the society.
Sounds good. So then the other big news of the week, of course, is you authored a book. Yes. Talk about a little bit who you wrote the book with, how did you write it, and what the problem you were trying to solve was?
Absolutely. So Singapore has been working on being a fintech hub. And last year I was in Israel for work, and I found that the whole country was a startup nation. And I tried to research, like, okay, how did the word startup nation came into being? And then I figured out that there are 2 people who actually wrote a story of how Israel became one, and then that became a standard. And when I came back, I was reflecting, because I've been from the starting of the fintech thing in this, and so this T-shirt is from the first edition of SFF. That shows I haven't put up weight in 5 years. That's good. How it being, and I started to reflect. And I figured out that Israel was a tech nation, a startup nation, because of what they call as chutzpah, that they will just go fight a problem, they will not be scared. And Singapore the average Singapore resident is a kiasu. It can look negative, but the positive side of the word is that we are scared of failing. We want to do right. We want to ensure that everything is done properly. And that fear is a strength in a regulated industry, where you have to still work with the regulations. That becomes a strength. And then I reflected, discussed with MAS, discussed with a lot of people that, is there a merit to have this full journey and story in one place? And we went through all the data and analysis to identify there were 3 main principles. One is write first, fast later. that Singapore would prefer, the culture would be that we need to do it right, even if that takes longer. Payment Service Act took 2 years. Yep. Digital banks, we were not the first ones to launch because we wanted KYC and all the other parts to be solved. So across every vertical, right first, fast later. The second was Singanomics, which is free markets, but with this nudge. So if there is not enough competition, there will be nudge. If there is specific infrastructure which needs to be built because there is not enough competition, then there will be forces to come and build that infra. And even the Payment Service Act, there's a clause that if one payment method becomes dominant, it will be forced to open APIs. Right. So till the time there is fair market, it works, but if there need be, there a nudge will be there. That unique Singanomics model. Mm-hmm. And last one is garden innovation, that Singapore doesn't have too much resources. So every few years, the nation will pick up a few things and throw everything at it. Earlier it was payments, then blockchain with the Ubin, now it's sustainable and green finance. So we pick one thing and then go all of it. Instead of like 1,000 flowers bloom, there will be priorities every few years. And yes, people can do other things if they want to. But the full bulk of resources will go after solving specific problems every few years. And through the journey, they built platforms like Fintech Festival, FTIG to do this. And what we have is we've interviewed 65, 70 people, including you in that, to capture the feedback of this, how immigrants are playing a role, how they are bringing their skills and experiences, how VCs are doing it, how startups are doing it. And I wrote it with a professor professor in Singapore, Prof. Lilian Ko, because as people who know me, I'm not the most organized person in my ideas. And as you would have seen, I've been going all around. I needed a counterbalance to my wild ideas to have the academic rigor. And we'll be launching it at 4 p.m. today. We'll share the live streaming link for those who cannot join in person. And please go to thefintechnation.com to get your copies.
Sounds good, and congratulations for that. So in the journey of interviewing these 65 people and kind of exploring some of their ideas, who's somebody that inspired you?
Raghav from Smart Karma, he said a very simple line, that Singapore doesn't need to copy other jurisdictions, because if we keep on continuing, Singapore will become a Singapore. And we don't want Singapore to become Singapore.
Fair enough.
Shailesh from Matchmove had a very interesting line as well. He said, when we look at inviting international companies to Singapore, we need to look at a balance in terms of what does that have an impact on the local talent supply for the local companies. If the international companies are going to poach from the local companies the talent, they can, because they have more resources. What's the right balance to ensure that there is net new talent generation and focus on net new talent generation instead of creating a talent scarcity for the local company?
The poaching ratio is
exactly
balanced.
So those are like actual practitioner insights which came. And those are like just some of the examples.
All right. So in the last 90 seconds, what's a company that you're familiar with that doesn't get a lot of coverage that you think is doing something amazing in the industry?
I would say 2 companies. MDAC, one of the very few profitable companies in fintechs. They make more than $1 million Sing revenue per staff, and there's like 60 people and 60 people with 60 million in bank. Not so sexy business, treasury. Alibaba is one of the key investors. And there's another company called Pure Software. They are a core banking behind players like Mandiri, Linkaja, and like 12 countries in Africa for Standard Bank. They're a core banking company with a small base here, and they've been servicing clients globally. They don't usually get a lot of coverage.
Wonderful. Well, thank you very much. Appreciate you having you here today. Congratulations on the book launch. Congratulations on helping build such a great fintech community here. And I know that you're going to be an integral part to the rest of this week with the Singapore Fintech Festival.
Thank you so much.
Pleasure, sir.
Thank you.